Hey guys, it's Chris Mincola with the Mincola Group over at West USA Realty, and we're doing our weekly housing market update. And today I just wanted to go through a few things real quick with you right off the bat and talk to you why it's a good time to buy. A lot of people are fixated, absolutely fixated, and understandably so about these interest rates because they've almost or pretty much doubled from where they were in the high twos, low threes just a year ago. And so I want to go through a few things on why it's a good time to buy. Number one, the interest rate's just a number and it's all about perspective. Okay. It certainly is something to be aware of, but when we look at the interest rate, back in 1991, when people were buying homes in Arizona and the investors started coming in, they were buying, with an equity gains every year of about 4.5% back then in 1991. And the rates were like 6.5%. In 83, rates were at 16%. Rent's probably going to go up 18% this year, right? So because some people have been priced out of the market and there's just a demand there still in the Phoenix area. Again, a lot of people listen to a lot of the talking heads on the national news, and they get the national perspective, and 9 times out of 10 those people are usually wrong. They were wrong the last crash. They're usually wrong with the being way behind on things like stagflation and what that means for the markets and all those sorts of things, and what it would take to actually get out of this manufactured mess, which is being driven by a lot of the energy policies right now that we're seeing, not releasing permits, leases, and all that sort of thing. We certainly are at a high drilling capacity. We just need more, more permits released for fracking, more permits released for leases released for that fossil fuel, the coal, the natural gases, which we were the Saudi Arabia of natural gas in New York, for instance, and in Pennsylvania. That's a fact. We certainly can pump more oil and refine more oil if we had more refineries, but we haven't built a refinery in decades. So these are all things that play into this. I mean, just the fact that getting fertilizer takes natural gas, all these sorts of things. Our 88% of our base load on our energy costs from our plants and our grids basically comes from fossil fuels, nuclear, those sorts of things. So coal. It's really important to really understand how all these things work, and the fact that we did have the whole Solyndra debacle back in the day, which was a huge money grab. So I'm all for clean, and we have ways of burning, do it now, clean coal, clean oil, all those sorts of things. It is possible, and we're doing it compared to places like India and China, who aren't doing it at all, don't plan on doing it. But yet we're still bringing in and importing all this stuff while we're trying to play catch up on the electrical part. And then there's the whole thing of when you dispose of a battery the size of basically the bottom of a car, that's going to do a lot of things to the environment. So, and you have to dig for that lithium and all that sort of stuff. So a lot of this, I just want to point out, is manufactured, but I also want to point out why it's a good time to buy. It may sound crazy because we're so fixated on recessions coming, which again, we've talked about in the past, especially in the Phoenix area where there's jobs, that we don't necessarily, have to worry about it as much as maybe some parts of the country that don't have the jobs. And if we follow the jobs, we follow the economy, follow the GDP of a local area like Phoenix, we'll see that things are pretty good. Now, and if we look at it from the perspective of where the rates are. So the Fed, we talked about the Fed raising the overall basis points last week of 75 points. That doesn't necessarily mean that they raised it just for the mortgage industry, but it does affect it in the long term. So it can affect it in the long run more than the short term. But some reasons why it's a good reason to buy is the interest rate is just a number. Rates are historically still low. I mean, actually, in a kind of a more balanced economy, a balanced market, a thriving economy, our interest rates would probably be right around 6.5%. Okay. Um, but they've been kept low. And we'll probably see, which usually happens during recession. I've mentioned this many times before, and so let's say, once they release the idea that there is actually a recession going on, which I already think we're in one, but it takes technically 3 quarters to get there and announce that. And a lot of people saw this coming way back 17 months ago, with a lot of the energy and economic policies that were in place. But the fact is that, after about 12, 18, 24, 36 months at the most, we'll probably see rates come down considerably because, when we're in a bad economy, the interest rates usually drop eventually. So there's a little bit of lagging effect there. And right now we have this rate hike because of the inflationary factors. And those energy, things that we were talking about earlier, basically raises the price of everything from fertilizer that's made with the natural, elements of natural gas, energy, and just, getting those things trucked over, flowing to different places, our food and goods that we process on a daily basis, and need to have. So that's just one thing. So the interest rates are definitely, historically, you're still going to get an ROI, in other words, in your equity, especially in the Phoenix area. Now, we can also see better deals on homes, because we're going to have less buyers in the market, because they're afraid to or priced out of the market. Home sitting on the market a little bit longer, so selling's a little bit more willing to budge on price or concessions like closing costs and things like that. So there's more deals to be had. My wife and I, and a lot of people that I work with in the real estate industry are adding, real estate to their portfolios this year. Why? Because we know real estate is short-term good, especially in the Phoenix area, but in the long term, it's amazing. So do you want to be that guy basically that said, I'm going to wait till it crashes? Which again, this is totally different than 2008, because we've got a lot less supply, higher and better regulations on loans, which we've talked about all these things before ad nauseum. So totally different than back then. So the market is still strong. Every generation, looks back and says, oh, I wish I had done this. I wish I had done that, or I had done this sooner. So, don't want to be that person. Homes are still expected to appreciate, especially here in the Phoenix area, at a modest rate. But even at a modest rate, you're making bank. Okay. And again, follow the jobs. So we have obviously a great GDP and jobs numbers here in the Phoenix area. So I am not worried about it. Now here's some quick stats for you, and then we'll get more into the numbers. 28 closed days on market as right now, what's going on in the Phoenix metropolitan area. 1.83 month supply, 1.83 month supply. Now, again, if we were in a balanced market, we'd be 4 to 6 month supply. Over 6 month supply would be a buyer's market. I mean, that would be like you're getting deals all day long. 4 to 6 month supply, but a 3 month supply in the Phoenix area has traditionally been kind of like where things kind of move along at a good pace, and we're seeing bigger than usual equity gains, or at least modest. We've got our absorption rate at 54.53%. Our average list price is $767, which is down a little bit, as people are figuring out. You can't, you actually have to take the average appraised value now. You can't do what people were doing a couple months back, which was basically what it looked like people were doing, and what we had a lot of our clients wanting to do, because it's just the way the market was going, with the low supply, low interest rates, and high demand, and people moving in from California, which has kind of slowed a little bit now, especially due to the interest rates and things happening. But we've got, the people having to go by the actual average appraised value of the comparable sales in the area, the true comparable sales in their neighborhood versus going to the high end of the comp plus adding 10, 20, maybe even up to $50,000 and still getting it from cash buyers from California. So that's all slowed down. Then we've got the average sales price is 574. That's the average sales price. Almost 575. It's 574 and 948. And that's down a little bit. Again, but now that's because it's not that people's home actual the average appraised value of what it's actually worth is good. It's just that isn't just that huge demand and that super low supply, because we've doubled our supply since March in the Phoenix area. So there's those factors that are in place along with the interest rates. And the list to sales price ratio is actually very strong at 99.67. So they're just under what they're asking for is what they're getting, just a hair under what they're asking for. Usually that number kind of, we like to see that usually, above like 9.2 ish means we're in a strong market. Before we're at, 101, 104, but this is not a bad number, in other words. So we're doing good there. As far as just short sales, distress, and those sorts of things, lender owned, we had 15 short sales and 13 lender owned. That is like almost Zippo in that kind of a, in our market, in our area, with being the fourth largest city in the country in population, or fourth largest. Maricopa County here in the Phoenix area was the fourth largest county. So huge, and we're still, again, 28 closed days on market. So if you're pricing your home correctly, it's going to sell. But again, for buyers, you're not going to have to compete with as many people, and you're not overpaying like we were before just a couple months ago. 45% of the inventory is at under $500,000. And from 500 to 999,000, we've got 41.1%, which is actually more than doubled. It was about 20% not that long ago, just a couple months back, actually. So huge. And then over $1 million, you're at 13.4%. So there's some quick stats. Now, getting more into this whole, interest rate hike. This is all basically due to the idea of trying to combat inflation, which, again, I'm not an economist. You certainly don't have to go by what I say, but I feel like it's manufactured because of energy policies and some of the other policies that are in place right now. So, it spiked, our mortgage rates have spiked, from 5.2 to 5.7 for the week ending Thursday. But, for some of you buyers out there, you may be able to get an even better rate. That doesn't mean that that's an absolute. And also, actually, depending on your credit score, we actually have, through our loan team, preferred lenders, we actually have programs at 3.75%. So make sure you reach out to us about that. 3.75%. Now, you got to have good credit, but they're there. So those numbers are from Freddie Mac. And again, these numbers have, since March, basically gone up about 3 times, up 150 basis points overall. And last Wednesday, we had the 75 basis point hit, highest rate basis point hike since 1994. So huge, right? But not the end of the world, like I was talking about before, because we do have modest or better than modest appreciation here in the Phoenix area. And here's some other good news for you. The lumber prices in the last month have gone down 12%. Year over year, they're down 47%. And the peak was at 2021. In 2021, that was the peak. They're down 65% since 2021. So great news there. Asking prices are down a little bit. Contract prices. Now here's one for you. Because this is where the rubber really meets the road, right? You're under contract and your closed prices. So, and again, it's just a matter of a little bit of a lag, because you've got 30 to 45, maybe 60 days, our typical closing periods for close of escrow. Those are escrow periods. So we look at that under contract and closed. The under contract prices have gone down from 314 to 311, and the closed price that's 314 price per square foot, down from 311. Okay, down to 311 price per square foot. Over 300 though is a lot for our area, a lot. So again, we had a lot of this inflation that went into real estate now because of the interest rates and the oversupply, which I'm going to talk more about in a minute. Who's actually selling these properties? We've got this little bit lower under contract prices because the demand has also gone down due to the interest rates or some of the scare tactics going on out there in the mainstream, national news. But again, in the Phoenix area, we're doing well. Closed prices so overall values of the actual average appraised values are doing phenomenal, absolutely phenomenal. Are you going to get, high-end comp plus 20 to 50,000 like you were 3 months ago? No, you're not going to do that. But you are going to see a minimum of, I'm just being modest here. Your historical average is 5 to 6%. We're probably going to see, at least 8, 10, 15%. I'm guessing closer to 20 to 25%, but let's be modest and say 8 to 10% equity gains. That's amazing. Okay, again, historical averages 4 to 5%, and over $300 price per square foot is like, those are record breaking numbers for our area in a matter of what, a year or two. They've pretty much doubled, if not tripled, in certain areas of the Phoenix area. So it's crazy. Closed prices 305 per square foot, 305 per square foot. So moving right along with those closed prices per square foot, that really tells us what we're looking at and so that's over where we were even just a couple months ago at the peak. So that's still looking good. Now, who are the sellers? Well, active listings again are well over 11,000. Okay, where again well over 11,000. So in a balanced market, we would see more than double that, or about double that at least, if not triple that. So we're way off from there still. But who are these sellers? Multiple people who have multiple homes. So people are doing well. They have second homes here. They maybe come here in the wintertime. Okay. Number two would be landlords with multiple properties. Okay. And three would be short-term rentals like Airbnbs. All right. A lot of people got into that when prices were lower back in 2019, 2020. Rates were still low. People were getting into that whole thing. Some of them really not experienced in it, but new home. Here's a good one for you. New home listings built in 2021 or later. Okay, looking at the active listings, they are actually up 13%. And that is up from 11.6% just about a month ago. So that's actually a good thing. Okay, so some of the builders are starting to catch up. We're seeing a little bit, more concessions, a little bit. Prices are still going up on those, but we're seeing that they're offering a little bit more concessions and stuff like that. So that's always a good thing for buyers. Okay. And again, a little less competition there, so a little bit more inventory. Listings under contract right now are actually we're looking at, let's see, about 96,000. I'm sorry, 9,600. That's actually the lowest since, guess when? 2008, right? Last year they were at listings under contract were, let's see, at just over 11,000. Okay, so were at 9,600. Last year they were at over 11,000. So changes there, but again, we'll see if those numbers, how they intersect here. Let's talk about our CMI. CMI is from the Crawford report. Crawford Market Index basically gives us this index to work with to tell us where we are. At 100, it's a balanced market, or anything between 90 to 110 is a balanced market. Anything over 110 is a seller's market. Anything below 90 is a buyer's market. So, and on their index here, if we look at some of these numbers, I want to point out a couple of cities here real quick. In June, Buckeye is down to 131. Last month it was at 182. Okay, so that's dropping quick. It's still technically a seller's market, but it's down big time. July, we're looking at, let's see. Oh, I'm sorry, not July. June for Maricopa and Queen Creek. They see Maricopa's at 147. These are the three lowest I'm giving you on the CMI, on the Crawford Market Index. Maricopa's at 147. Last month it was at 212. Okay. And these are, I would say Maricopa is like one of the less expensive areas, more on the outskirts of town, in Southeast Valley to live in. So we see that it's gone from 212 down to 147 on the Crawford Market Index. So it's still technically over that 110 mark, seller's market, but it's gone down quite a bit. Queen Creek went from 238.7 last month down to 145.6. So big decreases. So Queen Creek and Maricopa probably by next month, along with Buckeye, I'm guessing they're probably going to be right in that balance range. Of a seller's market. The highest on the index is Fountain Hills at 305, then Scottsdale at 253, Glendale at 242, Mesa at 235. They're all down over 30%. All those homes, or those cities, are all down on the index over 30% though. Okay, so dropping quick. Again, we've had a double in supply and a double in interest rate, right? So that's obviously affecting the demand. So let's look at the overall Crawford Market Index, or CMI numbers. The market index, the overall number is 216.1, 216.1. That's the overall number. Again, over 110 is a seller's market, below 90 is a buyer's market, and in that middle range of those numbers is a balanced market. Your demand is at 91.7, 91.7. Okay, so we'll come out here next week. We could be below 90 on that, which means that demand is in the buyer's favor, right? So let's look at the supply. So the supply is at 42.4%, 42.4%. That means we are at, let's see, about 58% below normal. But of course, just a couple of months ago, we were, much higher than that. We were about 75% below normal on that range. So guys, that's all I have for you this week. Sorry, I went a little bit longer, but I wanted to explain a couple of things on kind of the front end. These interest rates are definitely, something that's a matter of perspective, but we've got to keep an eye on the idea that when we talk about what a balanced market really looks like, or a buyer's market, we're way off on supply still, and the interest rates are certainly a matter of perspective. Now, one other note I'll just say on that is we could be, looking at easily, 6, 7, 8% interest rates here pretty soon. We'll have to wait and see where this goes by the end of the year. But once we hit a recession, over time, we end up, those rates end up dropping. So just keep that in mind, along with the equity gains that we've seen historically, even with higher interest rates here in the Phoenix area, as I mentioned at the beginning of this, and the reasons why it's still a great time to buy in this market. Okay. And just to show you, not making that stuff up, buying a new home myself this year. So Guys, if you have any other questions, let us know, and we'll go from there. You can always link to us down here below, but check us out at 480-788-8569. You can always call or text us there. Email us at home@mincolagroup.com, or check us out at mincolahomes.com and mincolagroup.com. And make sure to follow us, like us, and share us with your friends, and subscribe to us here on YouTube and wherever else you're seeing this. Please make sure you go ahead and share this with your friends and follow us and like us. We'll talk to you soon. Thanks.